Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Steve McGrath of Level Capital Partners. Steve and his acquisition of SaaS platform TapMango was actually one of our early investments. I loved hearing so much detail on a few of Steve's other deals. Nicholas, any takeaway from our conversation with Steve that you can share?
I was fascinated to hear about how Steve got started as an independent sponsor. He used to work as a private equity buyer at a big family office. And at one point, the family office decided that we don't want to do direct deals private equity any longer. This happened at the time when Steve was under LOI with the company to acquire. And Steve happened to really like this deal. And in this case, his employer, the family office, is telling him, no, you got to let that go. Tell the seller that we're not going to do this after all. But Steve, at that point, decided, I love this deal. I'm going to quit my job and I'm going to find the capital to consummate this deal independently. So he quit his job and formed Level Capital and was able to close the deal, re-sign it with the seller, keep him on board, and woke up soon after realizing now I'm an independent sponsor. And I think this is interesting because I have to imagine there are just so many people out there working for large private equity firms where their investment committee turns them down for whatever reason it is, or their firm changes strategy. But they're out there on someone else's dime, building relationships with intermediaries and sellers of businesses that ultimately their employer doesn't pursue for whatever reason. And this just seems like the best possible way to enter the field as an independent sponsor, because you get all the training and somebody else is paying you while you're searching. And then at some point, you might get that opportunity to do one of the deals independently. And then you're in the game, because all it takes is one deal with one management fee so you can pay your bills. And then you're in the game and can build a platform from there and acquire more businesses.
Well, and so much of the hurdle of getting in the game is being unemployed for 2 years as you search for that first deal, not even knowing you're going to actually find one. So if you can have a live deal in hand before you quit your W-2, it's so powerful. And this isn't the first time that we've seen that. Azar Quater was the same thing. Now, the story that we covered in Azar's interview was a later deal. But his first deal, as I recall, was a similar situation where the firm where he was at was uninterested in a deal. And he said, hey, guys, can I go pursue this independently? And he did. And that's how we got started. Max, what did you think of our interview with Steve?
Yeah, well, I love the point that you both just brought up about how he got into the independent sponsor game. And it was a shortcut. It was, he avoided that long search and period of uncertainty. He took a plunge overnight and became an independent sponsor. Steve's a great guy. I met him during the TapMango deal. I was involved in some of the financial diligence. Obviously, Minds Capital invested in the TapMango deal, which is a SaaS tech-enabled service deal. Steve's focused on those types of businesses as well as healthcare businesses. It was interesting in the interview that he was very vulnerable in discussing the CarePlus deal that he had, which had not one, not two, but 3 black swan events occur during his hold period. Inevitably, it's going to happen to most sponsors during their career. If they have a long career in entrepreneurial private equity, they're going to have a situation where the deal just doesn't go as planned. And, it reminds me that it's not the fact that you got into a deal that didn't go as planned. It's what do you do after you get into a deal that's going south? How do you pick yourself back up? What do you do with your investors' money? What's the strategy? Steve discussing this deal that didn't go as planned, he mentions that it was actually, in his mind, one of his biggest successes because he worked really hard and he was very pragmatic, and he was able to still actually get some ROI for his investors despite going through a really, really rough time. he's a tough guy, and he got through it. And he's had some other deals that have gone much better in terms of ROI. But I found that very interesting. It made me have even more respect for Steve to hear about that.
Question for you, Max. So when you brought the Tap Mango deal to us in Minds Capital, you do hundreds of QFEs and work with hundreds of independent sponsors at LCS. But can you share a little bit about, and we don't need to go into great detail here since I'm putting you on the spot, but what was it about Steve and maybe a little bit about the deal that made you filter that through? Because you brought that to Will and me back in the day and said, here's a strong deal and a really strong sponsor. So what really distinguished him in this situation, would you say?
Well, I can tell you exactly what it was. So Steve had experience. He had a bit of a track record in SaaS. I like SaaS. Just from a personal standpoint, I've done some SaaS investing. I like the space. I like the fundamentals of SaaS for a good deal. But it was about valuation. That was point number one. The deal was valued very favorably for a SaaS deal, and yet the deal had very high retention rates. So the customer retention, the net customer retention was above 90%, and the business was profitable. So the business had fairly strong EBITDA and quite strong revenue growth as well year over year. So it had sort of the three components. If anybody listened to the Bob Coven interview, revenue retention, strong growth, strong EBITDA margins, and a great entry valuation. That's why it was compelling for me. That's why we invested in the deal. And so it'll be exciting to see what happens.
Max, I'll just add to your point about Steve talking about a very challenging first deal that he did. And he uses the metaphor of landing Apollo 13. You'll hear that throughout the interview. Everyone understands, investors, capital providers understand that deals can go sideways, can go or worse. And so then it's, what is the sponsor going to do about it? And in fact, you as a sponsor in a situation like that can not only emerge with your reputation intact, but actually enhanced. Even if the numbers don't look great, if you can salvage the capital and even maybe provide a little bit of a return. And I'm reminded of the line in the movie Apollo 13 where the Ed Harris character says something like, "This is going to be our finest hour," sort of thing. So just landing the thing and getting through this crisis, not going to be the big victory we all hoped for at the beginning of the adventure, but just landing it is going to actually demonstrate us at our absolute best. Very powerful concept, I think, and one that should reassure people who find themselves in sponsors who find themselves in such a situation, but also motivate them to just pour themselves into righting the ship, even if it's not going to be a big return. Let's get to it. Here is Steve McGrath of Level Capital Partners. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Steve McGrath, welcome to the Minds Capital Podcast.
Thank you for having me. Good to see you guys.
Steve, you were a deal maker at large multi-billion-dollar family offices when in 2016, your then employer pivoted away from private equity. They had a deal under LOI. You gave notice, reached out to that seller to have that LOI re-signed with you and your new entity, Level Capital. And from your home office with Legos surrounding your feet, you scrambled to raise the capital for that deal and get it done, which marked your first foray into being an independent sponsor. That was about 9 years ago now. Today, you and the team at Level are focused on healthcare and tech-enabled businesses. And we here at Minds Capital are actually investors in your latest deal, a SaaS deal, Tap Mango. First question for you, Steve. Do you look back at your Lego days with fondness or with dread?
It was a great experience just in terms of people don't view private equity as entrepreneurial, right? And I literally was just, as you said, the situation kind of sprung itself upon me, right? So my current employer, Harbert Management Corporation out of Birmingham, great firm, decided to get out of private equity. And I went to the seller that I was working with and just made this thing up called Level Capital Partners. And then I'm sitting in my basement with Legos all around me, trying to raise millions and millions of dollars and get a deal done. So, I think people don't think as private equity as entrepreneurial, but it certainly has been an entrepreneurial experience for me. Just kind of jumping into that without knowing kind of what I was becoming at the time. But fast forward, 9 years later, we've got 5 platform deals done, exited 2, and looking at more.
Well, to the point about entrepreneurial, the view of private equity is maybe not entrepreneurial. We actually internally have taken to the phrase entrepreneurial private equity to describe independent sponsors, because it does feel like this is entrepreneurship in the world of private equity. And you're not the first story we've heard where with really humble, scrappy beginnings. But I see, framed vintage maps on the wall behind you now. So there's been an upgrade. Yes. The setting is more appropriate these days. Actually, the other thing about your story, Steve, that is I don't know if it's a pattern or a coincidence, but that you started your business with a deal, with a live deal, with a deal in hand. Is that a coincidence, or is that something that you would prescribe for a would-be independent sponsor listening?
Yeah, I mean, we can talk about this in depth, but I didn't know what I was becoming an independent sponsor at the time. Right. My employer decided to get out of private equity. You're sitting there faced as with a stay-at-home wife and 3 kids. What am I going to do next? And, I liked the deal. So I just kind of, without even processing the long-term ramifications or path, said, it's not going to hurt to go get a good deal done. So I did that. Right. And, in terms of advice to other sponsors, I think this model is a great model. The 2 stress points as an independent sponsor are, 1, obviously getting a deal under letter of intent, and then 2, going to have to raise the equity capital, right? Those are the 2 stress points. Once you find the recipe for those 2 things, then, it's a great model, right? And, being 9 years into this and having done deals with some great investors, Level's obviously kind of broken the back on those things. For new independent sponsors, yes, I think it's tough to just declare yourself an independent sponsor. I think one piece of advice would be, if you think this is something you want to do, right? Sometimes these relationships with the companies that do independent sponsor deals, you've got to build that trust in that relationship. So start working on maybe figuring out what your first deal is before you necessarily rip the Band-Aid off 100%. And it just takes one relationship and one good company to get going.
And do you find that now, almost a decade later, that it still feels kind of as entrepreneurial? I mean, aside from the upgrade that we've already talked about, does it still feel kind of like an entrepreneurial venture that you're on?
Yes. And
how does that show itself?
I've made a conscious decision, and we can get into this a little bit more, but yes, I've got an office, I've got full-time W-2 employees now, but it's still very entrepreneurial, right? If my associate has a problem with his computer, I'm Level IT, right? I'm processing payroll, right? So it's still very entrepreneurial. I've made the conscious decision to not go build a team of 10, right? Because one of the things that I like about this model is, you don't have $250, $500 million that you have to put to work under a clock, right? You can go find good deals. You can, at some level, wait for the good deals. I built this thing up to 4 platforms, and I wasn't looking at new deals at all. I was just focused on making sure that those 4 deals were successful and supporting the companies. And then as we sold a couple, now it's buy mode again, right? And so the flexibility of the model that, there's flexibility offered to the investors, but there's flexibility to the independent sponsor too. So I've got control of, hitting the gas and taking my foot off the gas to make sure each deal is successful in a way that you may not be able to do in a committed fund. So, it's definitely still entrepreneurial. And at this point, I don't know if I could go back and work for somebody after you become your own boss for, 9 years and, taste that and experience. I like the model we have at Level. I think it works, and don't see it changing anytime soon.
Well, we want to turn our attention here in a minute to one of your deals, but you just referred to the model at Level. Now, did you mean something particularly differentiated there, or did you just mean sort of the flexible independent sponsor model?
Well, I mean, I meant the flexible nature of the independent sponsor world that, again, I'm sure you guys have covered this in other podcasts or whatnot, but, there's flexibility to the investor in terms of picking what they want, picking the team, picking, the asset type, writing a check without a commitment for further investment. But, again, there's flexibility for the independent sponsor. In terms of Level's model, right? I do nothing different than what I did when I was with committed funds, which, there's different flavors of independent sponsors out there, but I'm going out, getting deals under a letter of intent, starting the diligence, taking the dead deal risk on the diligence providers. I think that risk is what enables you. One, I think it gets respect from your prospective investors, right? That you're real, that you know what you're doing. Some of the investors like to be pulled in, as early as possible and be involved in that diligence and be side by side with you on that diligence, but that varies by investor. But I'm doing everything I did as a member of a committed fund. The only difference is, I'm raising the equity capital the same way I would raise the debt, at a committed fund. So, and I'm taking the committed fund private equity world and just doing it deal by deal. And, there's others like me out there, but,
sure.
So. Steve, across 5 platforms now, you've remained a solo independent sponsor. You've built a team of W2 employees, but as far as, having a real 50-50 partner, you've elected not to do that, right? So far across. How has that decision-making been? Is that something you have revisited? And what are your thoughts on that?
Look, over the years, I've talked to some close relationships and like-minded guys and some people doing the same thing, right? I think to do that, you've got to, everybody's got to be in the right place of their journey, in their career and have it work out. And you got to sort out economics in that situation. In this model, I'm taking the personal risk, right? So bringing in a partner needs to be somebody that's willing to take that personal risk too, on every deal. Once I get into a deal, right? I'm bringing into every deal, I'm either bringing in an operating partner that has specific expertise or value add to that asset, and or pieces of the management team, right? And then I've got, usually an anchor equity investor that is involved at some level. I've had, everything from completely hands off to, wanting 2-3 seats on the board. And so, once I'm in an asset, I don't view it as a big deal that, I'm, the lone partner within the firm, right? Because each asset has, additional levels of support than just me. So yeah, I certainly have thought about it. There's a couple guys that, one who's, just became CEO of a company that, I'm waiting for him to exit that, and we'll see. I may have a partner at that point.
One of my friends says that the most dilutive thing you can do to your company is to bring on a co-founder and effectively reduce your economics by 50%. What are your thoughts on that?
Well, so one, I think that bringing somebody in, they kind of have to jump in and take the same risks as me, right? And so with the deals that I've done, I don't think that impacts that. I think that's an easy, logical conversation. Hey, you're not carved into the economics that are in process, right? But as we do a new deal, splitting that is fair as long as, people take equal risk. I mean, the independent sponsor model is all about risk and reward, right? I'm taking tons of risk on the front end for what is hopefully an outsized return on the back end, right? And so, you got to have the right partner. If I were to bring on a partner, they've got to have the right DNA and calculated risk-taking, mindset that I have.
You mentioned earlier that you had exited 2 platforms out of the 4 you had, and then recently you added another one, which is your 5th platform, and you see yourself as currently in buy mode. How does that go in your head from year to year, whether you're in buy mode versus sell mode? And when do you know that you have capacity to take on more? Is it driven by the market and external factors, like this is a good time in the M&A market to buy, or is it 100% based on your own capacity as a sponsor?
It's based upon capacity as a sponsor. I know, in the lower middle market, I don't believe that macroeconomic swings dramatically impact, what we're doing. Certainly there's better times to buy and better times to sell than others, but there's still good companies out there at all times, right? And, so getting into an asset, the flexibility that we talked about earlier in the conversation, I can take my time and find the right asset and choose the right time. And sometimes I build relationships with a company or management teams over an extended period of time, right? So for me, it's predominantly driven by, I need to make sure every investment is successful, right? I'm too competitive to, turn to investors and say, hey, sorry, we lost our money. And I can't even comprehend having to have that conversation. So it's about making sure that the portfolio is doing well and stable. And once you've got the right management team in place, the right strategy in place, and you're seeing the growth play out, my capacity, my bandwidth opens up. And so I think 4 or 5 assets at a time is a good model for what we have right now, excluding, ignoring potential additional headcounts. But with what we have now, 4 or 5 is great. We've got 3. 2 of those are in good stead and mature enough that they could see an exit before too long. Obviously, we just bought Tap Mango, so lots of work to be done there. So that kind of says, okay, we need to go prepare for, we're at 3, we can be at 4 or 5. Let's start looking around, trying to find the right asset. And, even more so given that there's a couple that could see an exit before too long. So I think over the next 2 years, we're in buy mode until I've got, 4 or 5 that are in the beginning to mid part of their investment cycle. And, it's that hunker down mode again, which is making sure every asset works.
If you had a partner, a true 50-50 partner at level, would you have 2x'd that capacity? Is that how it works?
If you have the right partner, in theory, yes, right? But as we just talked about, if my economics are 50% in 2x the amount of deals, you're at the same place, right? And so, I haven't thought about it that way before, and I like kind of a more concentrated portfolio, right? If we had 10 assets with 2 partners instead of 5 with 1, I still have to know something about those other 5 and be supporting those other 5 at some level. So, I think that math works. I don't know if it gets me ahead. If I go to 3, 4, 5 partners, then that, I think the math maybe makes more sense there. But you know, I've enjoyed the pace of which Level has executed. The economics are enough to, you know, be happy with. There's a phrase that isn't a new phrase to the universe, but one of my partners at another firm, you know, introduced me to it, which is pigs get fat, hogs get slaughtered, and I'd prefer to be a pig.
Well, Steve, let's turn our attention to one of your deals, which you were kind enough to give us a case study on. CarePlus. Talk us through how that came to be.
So CarePlus was the first deal at Level, and that was a deal that I had under letter of intent under Harbert. Harbert made a strategic decision to get out of private equity. So I drove to Athens, Georgia. I'm in Atlanta, you know, drove over to Athens and sat down with the sellers and said, hey guys, just so you know, Harbert's getting out of private equity. Don't worry. And I literally gave him a termination letter from Harbert and a, you know, replica LOI from Level Capital Partners. And, you know, I had to walk them through what that meant and, you know, what the potential impacts, if any, to the deal were. But yeah, that was my first deal. And as we said before, it just kind of happened.
Steve, that must have been a huge red flag to them. They think they've got a deal with a family office, a big established family office. And then the guy at the family office, one of the guys on the team is now doing his own thing. He doesn't have the capital. He shows up saying, we're going to do the same deal, but now it's just me. It's not the family office. We all, from our world, understand that, but the optics of that to, you know, folks on the other side of the table must have been very unsettling. Did you get that sense?
You know, not to a large extent, right? I mean, you know, this is a deal that one had been going for a while. It wasn't at the beginning of the deal. Diligence was already being conducted. So there's the whole concept in deals of, you know, how pregnant you are in the deal, and the more pregnant you are, the harder it is to walk away, right? So, you know, they were down that path, right? And once sellers get somewhat towards the end of the finish line, you know, it's only natural. They've been counting their money and figuring out what they're going to do with it, right? And so, you know, I think one, you know, they had built a relationship and some level of trust with me over the course of this process. And I was the point person on the deal. So it wasn't like somebody in Birmingham was, you know, their key contact or the one walking away. And, you know, at that point, if you're 25% away from the finish line, you know, I don't know what they had to lose to giving me a shot to try to get it done. So, I think, you know, the timing of where we were in the deal probably helped me at some level.
Yeah.
And then once you do a deal, then it's a lot easier to go to the next guys. And, you know, at this point, having done 5 deals and never had I've never gotten a deal under a letter of intent and not gotten the deal done. Right. So I think that's a helpful speaking point to prospective sellers and partnering with me.
Certainly. Great. Well, tell us a little bit about CarePlus, about the business itself, Steve, and then we'll hear the story of how the investment went.
CarePlus is an provider of anesthesia services, predominantly through CRNAs, to outpatient surgery centers, predominantly in the gastro world. So we would partner and contract with surgery centers and gastro groups, and there were some other disciplines that we serviced, and we would place and manage at some level the CRNA conducting the anesthesia services. We also had a recruiting arm that was small that came with the deal. It was a separately branded recruiting arm that the sellers had that came as a part of the transaction. It was really small when we started. We'll get in, you know, as we get into how the investment played out, that became an important fact pattern for us. And one thing that I've done in several healthcare services investments on the practitioner side is have a recruiting arm associated with that type of business. It helps the practice management business perform better, just in terms of you've got a recruiting machine that's finding personnel and giving you some of the top tier personnel and just helping that side of the operation. Plus, it's an additional service line that you can grow and create value off of. So as we went through CarePlus, CarePlus, before we get into that, so we've had 2 exits. One was a very attractive exit. This one, we made a slight return, but that was the equivalent of very strong return, given some of the dynamics that we're going to walk through. The industry as a whole kind of got walloped by a couple of things that we'll talk about. But, interestingly, all my investors, I communicate to my investors, on a regular basis. They all knew what was going on. They all viewed this as a win, given kind of the macro dynamic. Obviously, when you get into one of these deals, you're not, trying to get a little bit of return. We're underwriting to 25% and 3x in all of our deals. But a couple things happened in the life cycle of CarePlus, one of which was, in the healthcare industry, I'm not sure if you guys are familiar with kind of the whistleblower dynamic, right? So employees at some level are incented to report potential problems within a practice management business, and then they share in whatever, fee, fine, or punishment that the government gets out of that. So unfortunately at CarePlus, about 6-7 months into the deal, a whistleblower employee who we had never heard of, never worked for us, or the company anywhere near leading up to the deal, but a longer backdated employee apparently submitted a whistleblower event, which, without getting into the details, wasn't an accurate accusation, but we had the government in our shorts and dealing with this regulatory event for years. COVID happened in the middle of this. We bought the business in 2016. We were probably nearing an exit when we bought this in 2016. The whistleblower thing showed up in 2017. COVID started obviously in 2020, which delayed the resolution of this. So we were performing very well, and the market was in a good place, but we could not exit the investment at probably the natural time to exit it because we had this regulatory whistleblower event going on. You can't go sell a business while the government's investigating something with the business. We resolved that. We did the documentation correctly. So, we were protected. The company was protected. The investors were protected. It got resolved, but we lost a lot of time. And then shortly thereafter, there was healthcare legislation called the No Surprises Act, without getting into all the gritty detail, but it was a legislation against balance billing patients for services or things that they weren't expecting. And while our company did not balance bill patients, there are several industries, including anesthesia, that basically saw dramatic reimbursement pressure and drops as a result of this legislation. So, we grew revenue, interestingly enough, on this, and I'm going to pull up a couple stats here real quick, but, we took revenue in this business from $35.3 million to $74.7 million, but our EBITDA went from 7.8 to 3.5. So right. Despite that very strong revenue growth, we contracted on EBITDA, and we were able to get out of the exit successfully in all regards because, as we talked about before, we also had a recruiting arm. And so the anesthesia side of the business is what was taking the pressure, but those industry dynamics aided the recruiting side of the arm. So having that revenue diversity within the business and not being solely reliant on the anesthesia piece is what helped create a successful exit. We had a strategic come in and buy us largely for the strategic value that the recruiting arm was going to give to their anesthesia business as well.
So your salvation of the deal was really good fortune, because the recruiting piece was not part of the thesis at any time. It was just this kind of come along business line that ended up being the thing that got you out of the deal.
Yeah, I wouldn't say that completely, right? Because, in a prior life, we had a ER and hospital medicine business, and we created a recruiting arm from scratch in that business. So, at some level, it's a part of the playbook, right? And, and for reasons like what we just experienced at CarePlus, but we made a conscious effort to try to grow the recruiting business, improve the margins of the recruiting business along the way of the investment. We didn't completely realize during the journey of the investment that was going to be what gave us that strategic value to still return a successful investment necessarily. But revenue diversity matters.
Yeah. On the whistleblower exposure, is that something that is just a fact of life in healthcare land, or is that something that can be a risk that can be mitigated going in?
Great question. At some level, I do think it's a risk of life in healthcare, right? And I understand the premise of wanting to encourage employees to step forward and make sure that their employer is behaving and acting the right way. But unfortunately, like many things in life, bad actors get involved in certain things. I mean, there are attorneys that call employees trying to find whistleblowers, right? Like, that's part of their business model. So, if you're getting into, so when we got into Suburban Orthopedics, which is one of the more recent deals, I was pounding the table on compliance, right? We need, you need to be able to demonstrate to regulators that compliance is at the forefront of what you're doing. You're thinking about it. You're continually evaluating it. A lot of the way to get in trouble, and we've never gotten in trouble in our healthcare investments, but I've learned a lot about the process through CarePlus. A lot of it's intent, right? So if you're intending to do things, then that's when you get punished. If you're able to demonstrate that you run a robust compliance program and are consciously trying to do the right thing, then that aids getting out of those situations, which may be unwarranted at your doorstep, but you can have the evidence that you're doing things the right way.
Going back to the CarePlus deal there, so you had a business with two business arms, one that was the predominant strategic focus, and then another one that came into play more relevant later. During the whole period, you have three major black swans with a whistleblower event, a legislative change, and COVID, all directly impacting your business and profitability. On our pre-call, you said that despite of all of this, or maybe because of all of this, landing this investment with a favorable exit felt like landing Apollo 13 and stands as one of your proudest accomplishments. You also really appreciate all the learnings you got out of the deal in the early stages of your independent sponsor career. So I just wanted you to flesh out on that and elaborate. What do you mean by landing Apollo 13?
Well, look, I got to give a lot of credit to the CEO that was in the chair at CarePlus. I mean, it wasn't a fun job for the CEO of a business going through all those things, but when you're in this business, anybody that's saying, "Hey, all my deals go according to Excel and according to plan, and returns are always," I think there's more credibility for myself and Level having an example like CarePlus, right? There was extreme amounts of adversity. We managed through it. We didn't give up. We did documents the right way. We handled ourselves the right way. And as I said before, my having a wipeout is not in my DNA, right? And so I think CarePlus and getting this to a point that people got their money was protected and they saw a little bit of return, and know the story of what we went through. As I go out and look at other deals and talk to other investors, that's not a bad story to have, right? They know that we're not going to walk away. They know that we're not going to, not fight all the way through an investment on their behalf. So I think from that standpoint, it's obviously didn't turn out the way we totally wanted it to, but I think it was something that gave me a lot of lessons about private equity. It gave me some validation as a sponsor that can manage through tough times, because I do think investors, if investors are investing in the lower middle market thinking that, it's all about fun and growth, there's challenges. I've always said, people can make Excel say whatever they want when you're underwriting a deal, right? It's never going to go according to plan like that.
On that note, you said earlier that every deal you underwrite to 25% IRR and 3x MOIC. So isn't that also manipulating the data if every deal is underwritten to the same return?
Look, I mean, you run upside and downside scenarios, and you've got to have a base case. Look, if you wouldn't invest in a smaller, lower middle market deal if you don't think that you can get 2.5, 3x return out of it, right? Just like this is an asset class where, going back to risk reward, there's risk associated with it. So the potential reward needs to be around 3x. And so, you're correct. I mean, I could make it say 5x, right? But we're trying to, and I know we talked a little bit on the pre-call, organic versus acquisitive growth. We're underwriting businesses that we believe organically can get to a 3x return. And the model's not rocket science, right? We're investing in asset-light, human capital-driven businesses. They're usually, lacking infrastructure when we come in. So the initial phase of the investment is getting the right management team in, making investments in systems, figure out the right processes. EBITDA may not grow out of the gate, but what you're doing is establishing an infrastructure within a business model that when you put points on the board and start scaling revenue, then the margins expand as well, because you've spent that upfront time investing, creating a real back office on the front end. So the businesses that we get into can scale. We're looking for business models that have those dynamics. We stay away from asset intensive things that, if for some reason you run into a bump, you have a balance sheet that's going to, prevent you from managing around a downturn or other sort of external force.
So when you underwrite a deal, you focus on organic, and so you do not include add-on acquisitions in there, despite being a deal maker. Independent sponsors are deal makers. Why are you so skeptical of including M&A activity in a base case pro forma?
So I wouldn't say skeptical, right? But part of, I believe, the attractiveness in going to, there's certainly some investors in the independent sponsor world that say, we want to build and buy strategy. But there's a lot, family offices, right? You don't want to have to keep calling your family office up saying, hey, I got another acquisition, I need more money, right? And so I view acquisitions as a luxury, not something that we base the investment thesis off. We just did Suburban Orthopedics just bought an ASC. We just did an add-on acquisition, right? And you have to go around to your investor group and explain to them why they need to put more money in the deal. And there's varying flavors of investors in the independent sponsor world. And like I said, there's some that want you to be really heavy on the M&A activity, but relying on that for your investment return is not something I believe in. I think you find a good business that's capable of scaling, differentiated, strong value proposition, and you can grow that to something that generates a lower middle market private equity return without having to put in additional capital.
I agree with this. And you bring up a good point there that the add-on acquisitions rely on additional capital from your existing pool of investors typically. And that's not necessarily a given, right?
Correct. So, we just did this ASC acquisition. 98% of the money participated again. Some people bumped up to fill holes. The way I do kind of the structure and the documentation, if somebody doesn't participate, I'm able to go bring somebody new in, right? I need to have that flexibility if for this exact reason, it's bad timing for the anchor sponsor and, we need to fill a hole, right? So the asset can't be hamstrung by that and needs to have some flexibility in terms of bringing in other investors. But, it's not that I'm adverse to M&A at all. And like I said, we just did an add-on with Suburban. But I think the independent sponsor model, it depends on who your backer is in that asset. If they're telling you I've got 50 million more that I want to put to work, go find transactions, then we'll do that, right? But the majority of people like the flexibility of putting in money on the front end of the deal and then having a discrete decision if and when there's another capital need.
Well, it's a different approach to targets, because if you're looking for a good business with all the potential you just described in a good industry, but you lead with the individual business that you found, the deal that you found, versus a consolidation of a fragmented industry. You go looking for industries and you start with the industry. That's kind of thesis number one. And then you backfill, okay, let's go find a target within that industry.
Yeah. And look, it's, I think the first or 5 platforms, we talked about this with Tap Mango, right? Tap Mango, there's tons of market share. Tap Mango can just go execute and take market share, right? So if you have a good business, it's a lot cheaper to invest in marketing and, internal capabilities to grow the business than to go pay a multiple for an EBITDA, for something that may be duplicative to what you're doing. So, absolutely, there's some industries that make sense in terms of roll-ups. I'm looking at a couple now that look like that. So if we pursue those, I need to find the right investors for that. Otherwise, it doesn't work. But to date, we've had 5 businesses that can grow organically, have strong individual value propositions, and we've been able to put points on the board.
Steve, can we hear about Affirmative, another one of your deals? A pretty interesting deal, a much smaller deal, SaaS. Can you tell us about that one?
This is an interesting one too, right? Most of the deals that I do are your typical, 4 to 8 of EBITDA initial platform. And I think this is almost a case study for the industry too, because Affirmative was, 15 plus year old company. When we showed up, it was about 2.7 of revenue and, probably 300,000 of EBITDA. And like you said, it's a SaaS technology business in the fintech space. There's not a market. There's a very small market for companies like this because everybody's got these EBITDA thresholds, whether it's 2 million, 3 million, 5 million, 10 million. And, not many people play in the 0 to 1 or the 0 to 2 space. So, this was an attractive business from the SaaS business model. But the financial profile made it challenging to find the right equity investors in the deal because the universe is smaller. And there's some aspect to, it's the same amount of work to do Affirmative as it is to do CarePlus, as Tap Mango. No matter the size of the deal, if you're doing things properly, it's still the same amount of work. But I've got an operating partner, a guy named James Rowe, who's a strong, fintech and financial institution guy, and we looked at this together. We saw a strong investment thesis with Affirmative. It was predominantly kind of a commodity ACH processing business, which processing is a volume game, pricing pressure, all that. But it had another solution called Risk Manager, which was focused on compliance and risk mitigation for ACH and other electronic payment types. There was only about 400,000 of revenue when we stepped into the business. So Affirmative, this is one of the ones that I think that from a maturity standpoint, we should be, discussing exits before too long. But we're excuse me. I'm just trying to, we're $5.5-6 million of revenue at this point, and that 400,000 risk manager revenue has grown to 4.5 or 5 million of that. So our investment thesis was on risk manager, not on the processing side. It's the classic, business school analogy where we took the cash cow and just kind of milked the cash cow on the processing side while investing in the emerging solution. And that strategy has played out pretty well for us. But this is an arbitrage situation where we came in and found a way to get a deal done on an asset that really doesn't have a big buyer universe or investor appetite, and have grown it to something that we can feed into that stronger market and more typical profile for PE investment.
Well, Steve, the other aside from the EBITDA being so small on the business when you bought it, the fact that your whole thesis here was really about, like you just said, milking the cow to feed the emerging opportunity. So if it's so fundamentally, this was a thesis around that emerging opportunity. Emerging is not a word we often hear in LBO land. You want proven high quality revenue. So you were starting to play a little bit. I don't want to say venture; that would be overstating it. But there was much more risk, was there not, in the very viability of the business that you were banking on?
Yes, but I mean, Goldman Sachs is a client of this business, and they were there before we came in, right? So, there were some real names in terms of FI clients that existed as we were coming into the deal. They're still clients, and we're continuing to add to those names. But I understand what you're saying, but there was enough there just in terms of proven value proposition. And, this kind of gets into an interesting piece of that, I think, is the overall market. But you always hear in deals how, hey, they don't know how to market, just, make some investments in sales and marketing, and it's going to take off, right? Like that's a part of almost every, book and banker process there is. That was the case here, right? There was the founders, great guys, but they didn't know how to market, right? And there was no process, there was no investment. And so this investment, we had a great solution. We still have a great solution. We've continued to evolve it, update the technologies. But the key to this investment has been finding the right sales process in what is traditionally a pretty difficult end market. It's not easy to sell to banks and credit unions. There's a lot of constituents. There's a lot of processes. There's budgets and budget timelines. So the key to this investment has and will be the sales engine and making that work. You hear that as an investment thesis overused, but it's proven to be true in this one.
For a deal that had around 300,000 of EBITDA when you first acquired it, and it sounds like it's been an incredible growth story since then. But what did the financing look like for a deal like that? Because obviously you won't be able to find an SBIC lender to engage here.
So we use no debt, which
So all equity.
All equity. There was rollover from the founder, right? We probably could go get debt at this point, right? And this goes back to some of the prior conversation we had. But my belief is that you generate returns in lower middle market by scaling the business and creating a more strategic business. That's how you create enterprise value, right? Debt. It's the only deal I haven't used debt. I usually am modest, around 3x, maybe 3.5. 4 gets me nervous in terms of a new platform. But this end of the market shouldn't be creating returns by delevering, right? We're not KKR. We're not going to go put 8 turns of debt on a business, pay that debt off with cash flow and then create equity value by paying off the debt. You've got to create returns by building a good business. So, I don't think the returns are going to be hampered at all here. Part of it's because it's a small deal, right?
But, an LBO, the L is there also to juice the equity return. So in the absence of leverage, it puts probably more pressure on organic growth. So you must have seen the potential for that in this situation.
I think we're going to get multiple expansion as well as, growth in the P&L, right? Right. There are multiple levers on ways to drive returns in lower middle market private equity. Obviously, one of those is using debt to juice equity returns, but that's not the only method to drive a return. I'm a believer that if you just focus on building a great business, the exit takes care of itself. And this was back at a committed fund, but we didn't grow EBITDA at all. Back to that building the infrastructure thing, and we had a strategic buyer come in and we got a 4x return on it because we had a strategic asset that we enhanced the value of through growing the top line and sophisticating the business. Even though EBITDA didn't grow, we got a 4x return out of it. So, I just think you can overcomplicate things. The easiest thing to do in this industry is find a great business with good people and focusing on continuing to make it a great business, right? If you do that, all the math will take care of itself. Certainly, our returns maybe have been impaired a little bit at Affirmative by not using any debt, but I wouldn't have traded that for the flexibility that we got out of not having debt in a small business, not having to worry about covenants, not having to go hire a sophisticated CFO, and having the cash flow to invest in the product and invest in the business.
And Steve, say again for us, it was about $300,000 in EBITDA, $300,000 in EBITDA, and $2 million in ARR when you bought it, and then where is it today?
It was just under 3
of ARR.
Correct. Actually, 300,000 of EBITDA, and we're now approaching.
And Steve, what percentage of that was the business that the FI business that was actually really what you were interested in growing?
400,000 of that 2.7, 2.8 was risk manager. Now we're approaching 6, and the vast majority of that is risk manager at this point.
That's amazing. So 6 million, you've grown the risk management business to almost 6 million, and the original SaaS business is under $1 million. Sounds like.
Correct.
Oh, fantastic.
No, I appreciate it. It's every deal's different, that's for sure.
Was there anything, Steve, that you wanted to make sure the audience heard? We're getting toward the end of our conversation here, but I wanted to make sure we hit all our topics.
I think we covered a lot here. Hopefully this has been helpful and entertaining for those watching. We're excited with what we're doing at Level Capital Partners. We don't market ourselves broadly. We just keep our heads down and try to do good deals. So appreciate you guys' support in the last deal and look forward into making that one successful too.
Anything that you're looking for, roles you're looking to fill, capital providers you're looking to meet, anything that listeners might be able to help you out with?
Yeah, I mean, look, I've got some great investor relationships, but happy to talk to anybody that's interested in investing in this end of the market. Having more relationships is better than not. And certainly, I think from a role standpoint, we've got our companies in a good place just in terms of personnel and all that. But always interested in introductions to investors and deals. So feel free to reach out. Love to hear from you.
Personal question for you, Steve. We have our Minds Capital offsite in October. It's exclusively for our investors and our portfolio sponsors. Are you planning to attend?
Yeah. So you sent me an email on that, and I haven't booked my flights yet, but I got the hotel and I've registered for the conference, and I got the hotel to enable to attend
Wonderful.
your event. So
amazing. That'll be great to have you there in person.
Remind me, is it before or after? It's after the event, right?
That's right. It's the day after the McGuire Woods conference.
Okay, great. I'll be there.
Great, Steve. We look forward to meet you in person, and thank you very much for coming on and sharing a little bit about Level and a couple of your deals. Really appreciate it.
I enjoyed it. Thanks, guys.
Steve McGrath, thank you very much, sir. Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.